If you want to start trading or get back to what actually works, master this strategy. It's built for beginners, but every profitable trader uses these exact principles. Here's the foundation everyone needs. I used to be one of those traders with a Christmas tree chart. 10 different indicators, all blinking and beeping like a damn casino. I thought I was a genius. But here's the brutal truth. All those indicators are just fancy ways to lose money faster. The only thing that matters is learning to read the market's language. This is called market structure, and it's built on one simple thing: swing points. These are the obvious highs and lows price makes as it moves. A swing high is a candle that's higher than the candles on both sides of it. A swing low is lower than the nearby candles. Now, in an uptrend, the market makes a series of higher highs and higher lows. In a downtrend, it makes lower lows and lower highs. These are the building blocks of everything. And these swing points aren't random. They're the market's way of telling you who's in control and when that control is shifting. Let me show you the two most important concepts you need to know. First is the break of structure. This is when price breaks a previous swing high in an uptrend. It's the market's way of saying the trend is still alive and kicking. Second is the change of character. This is when price breaks the last major swing low in an uptrend. It's the market's first warning sign that the trend might be in trouble. Watch this. We're in a clear uptrend, making higher swing highs and higher swing lows. Each time price makes a new high, that's a break of structure, a confirmation that buyers are still in control. But look what happens here. Price makes a sharp move down and breaks below the last swing low. That's a change of character. The market just told you that the trend structure is cracked. This doesn't mean the trend is over, but it means you need to be careful. The character of the market just changed from strong bullish momentum to potential weakness. Here's the key insight. You want to trade with the structure, not against it. In a trending market with clean break of structure patterns, you look for entries in the direction of the trend. But when you start seeing change of character patterns, you either take profits or step aside. This is how you read the market's intentions while everyone else is guessing. Most traders spend months figuring this out. You just learn it in 2 minutes. Okay, so you can read basic structure. Now, let me show you the most important decision you must make before even thinking about a trade. You have to identify the overall market state. Before you even think about entering a trade, you must answer one simple question. Are you in a trend or a range? This is the most important first decision you'll make, because different strategies apply to trending markets versus ranging markets. So how do you tell the difference? Here's the dead simple method that works every time. Add a single moving average to your chart, the 50 EMA. When price is above this line, you have an uptrend bias. When price is below, you have a downtrend bias. But what about ranges? Watch this. The 50 EMA will be flat, and price will be chopping around it. Here's what most traders get wrong. They try to force trades in every market condition. But the professional waits for the right context. If you're in a strong uptrend, you look for dips to buy. If you're in a range, you look for bounces off the boundaries. This single concept will save you more money than any fancy indicator ever will. Look at this chaos. Most beginner traders have charts that look like this. 10 indicators, 5 different time frames open at once, and they wonder why they can't make a decision. Most traders get wrong about chart setup. They think more information equals better decisions. But in trading, you need clarity, not confusion. Your chart has one job: to help you execute trades, not to analyze the entire market. So we're going to strip everything down to the essentials. First, pick one market. I don't care if it's Eurodollar, Tesla, or Bitcoin. Pick one and stick with it for your next 100 days. You need to learn how that one market moves before you start jumping around. Next, you need exactly 2 time frames. Not 5, not 10, 2. The 1 hour chart for structure and a 5-minute chart for entry. The 1 hour tells you the big picture. The 5-minute tells you when to pull the trigger. Now, for indicators, you get one, the 50 EMA. That's it. This line will show you trend direction. The goal is to see price action clearly. Price is the only thing that pays you. Everything else is just noise. Here's a question that will make you rich or keep you broke. Where do trades actually happen? Well, they happen at specific price levels, at support and resistance. These are the only levels where the market actually gives a damn. Everything else is noise. And here's where 90% of traders completely lose their minds. They start drawing lines everywhere. A line here, one there, trend lines going in every direction, like a spider web designed by a madman. Remember this like your trading life depends on it. The market only cares about 2 types of levels: real support and real resistance. First, forget everything you know about drawing lines. These levels aren't thin lines, they're zones, areas where price has repeatedly shown interest. Look at this level. Price has touched it 2 times. Each time, it bounced off this area. That's a support zone. It's not a single price point. It's a range of prices where buyers keep showing up. But here's the part no one explains. Not all support and resistance zones are created equal. You need to understand the difference between fresh zones and tested zones. A fresh zone is one that hasn't been revisited since it was created. These zones often provide the strongest reactions. A tested zone is one that's been hit multiple times. Each time it gets tested, it gets a little weaker. Most traders keep trading the same tested levels over and over, wondering why they're not working anymore. You need to hunt for the fresh zones that haven't been discovered yet. And there's one more concept that changes everything: role reversal. When a strong support level finally breaks, it doesn't just disappear. It becomes a powerful new resistance level. Watch this happen. We had a major support zone. Price kept bouncing off it. Then it breaks through with force. Now watch what happens when price comes back to test that same level from below. Rejection. The old support is now acting as new resistance. Just by understanding these simple concepts, you've already put yourself ahead of 90% of traders. Now I'm going to teach you something that most traders learn too late. The market is designed to take your money. It's not personal, it's business. And the way it takes your money is through liquidity hunting and inducement. Let me ask you something. Where do you think most traders put their stop losses? Above obvious highs and below obvious lows. That's exactly what big market players is counting on. These areas where stop losses cluster are called liquidity, and smart money hunt this liquidity. Here's how it works. You see a resistance area. It looks like a perfect short opportunity. Where do you put your stop loss? Above the highs, of course. So does everyone else. But smart money sees this differently. They see all those stop losses sitting above the highs as an opportunity. They push price up to trigger all those stops, collect the liquidity, and then dump the market hard. This is called inducement. The market creates a seemingly perfect setup to lure you in, then traps you before making the real move. Most beginners see this happen and think they just got unlucky. But you're different. You're going to see it as a predictable pattern. Here's the question that will save you thousands of dollars. Where is the obvious trade? And where would the stops for that trade be? Because that's where the market will likely go next. Let me show you this in action. We have a perfect looking support level. Most traders see this and think, great, I'll buy the bounce and put my stop below the low. But smart money sees all those stops below the low as a target. Watch what happens. Price comes down to the support level, breaks through it just enough to trigger all the stops, and then immediately reverses back up. They hunted the liquidity and then made the real move. This is why most traders get stopped out right before the move goes in their favor. They're not unlucky, they're predictable. And in trading, predictable equals profitable for someone else. Now we start building. The foundation is laid. Let me show you how to find an A+ trading location. This is a concept called Confluence, where multiple factors align to signal a powerful opportunity. Most traders are one-dimensional. They see a support level and they buy. That's it. They trade one reason and hope it works. The smart approach is to wait for multiple independent reasons to align at the same place and time. Here's your first Confluence model, and it's going to be the backbone of your entire trading approach. You need your higher time frame trend, plus a key support or resistance zone. Let me show you exactly what this looks like. On the 1-hour chart, we're in a clear uptrend. Price is above the 50 EMA, making higher highs and higher lows. That's your directional bias. Now price is pulling back to a major support zone. But this isn't just any support zone. It's one that used to be resistance. Remember the role reversal concept. So you have a higher time frame uptrend meeting a key structural level. This is Confluence, and it's where you start paying attention. But here's the key. This Confluence doesn't mean you trade yet. That's amateur hour. Professionals use Confluence to narrow down where they want to trade. Then they wait for confirmation. This is the difference between hoping and knowing. You're not hoping the level holds. You're waiting for the market to show you that it's going to hold. That's one of the 3 key pillars of this entire system, and we're just getting started. Now let me show you a weapon that institutional traders use as a daily benchmark. It's called the volume weighted average price, or VWAP, and it's the true mean price for the day, weighted by volume, like the market's center of gravity. Here's why this matters. When institutional traders want to buy or sell large positions, they use VWAP as their benchmark. They try to buy below VWAP and sell above it. This makes VWAP act like a magnet for price. So let me show you how to use this. Add VWAP to your 5-minute chart. You'll see it as a dynamic line that moves with price, but it's much more responsive than a moving average. Watch how price behaves around it. In a trending market, price will pull back to this line. It touches the VWAP, bounces off it, and continues in the direction of the trend. This is your entry anchor. Remember that Confluence zone we found. When price pulls back to that zone, you are not just looking for any entry. You're looking for a specific test of the VWAP within that zone. This is how you turn a good setup into a great setup. You have your higher time frame trend, your key structural level, and now your institutional benchmark all lining up in one place. So the absolute A+ setup is when the 1-hour trend is up, price has pulled back into a 1-hour support zone, and on the 5-minute chart, that pullback is now touching the VWAP line. This VWAP test is the anchor for our entire trade idea. It's the precise point of interest within our broader zone. But remember, this VWAP test is the anchor, but it's not the entry signal. The signal is a specific candle pattern that confirms buyers are actually stepping in right here, and I'll show you exactly what that looks like in just a moment. First, let's talk about a critical distinction that trips up almost every beginner. You see the price come down to your perfect level, the 1-hour support zone, the 5-minute VWAP test. Everything is aligned. The problem is, the amateur trader gets excited and buys immediately. They're buying at a location, hoping it holds. But imagine if you waited for one final piece of evidence, a confirmation that buyers are actually present and fighting back. The result is you would filter out so many failed trades where the price just slices right through the level. This is the difference between a setup and a signal. The setup is the context. It's the high probability condition we've just defined, a pullback to the VWAP that happens inside a key higher time frame support zone, all while the main trend is up. The setup tells you where to look. The signal is the specific event on your 5-minute chart that tells you when to act. It's the proof. It's the footprint of buyers stepping in and dominating sellers at that exact spot. The professional waits for this perfect alignment. The amateur buys the location and hopes. You now understand the difference between a location and a reason. Most traders never learn this distinction. Now I'm going to give you the most reliable entry signal in your entire arsenal. It's called the outside candle, and it's the market's way of screaming that the momentum has shifted. A bullish outside candle is a large green candle that completely swallows the body of the previous red candle. It's the market's way of saying that buyers are now in control. A bearish outside candle is a large red candle that engulfs the body of the previous green candle. It means sellers just took over with force. But here's the critical part. This candle pattern is only valid when it shows at your VWAP test. An outside candle in the middle of nowhere is meaningless. Let me show you this in action. We have our perfect setup, uptrend on the 1 hour, pullback to a key support zone, and price testing VWAP. Now we wait. Watch what happens here. This candle completely engulfs the previous candle's body. That's your signal. The market just told you that buyers stepped in with force at the VWAP level. This isn't hope, this is evidence. And the size of the outside candle tells you how strong the momentum shift is. A large candle with high volume is like the market screaming. A small candle is like the market whispering. You want the market to be screaming when you enter a trade. You want that outside candle to be large, decisive. This is your go-to entry signal. It's simple, it's reliable, and it works in all market conditions. Now I'm going to show you how to add a third layer of Confluence to your system. We're going to use Fibonacci retracements and extensions to find precision entry and exit points. The Fibonacci retracement tool helps you identify where pullbacks are likely to end. The most important levels are the 61.8% retracement, also known as the golden pocket. When your VWAP test also lines up with the 61.8% Fibonacci level, you have triple confluence, trend direction, VWAP, and Fibonacci all pointing to the same level. And here's where it gets really powerful. You can use Fibonacci extensions to set logical profit targets. The 161 and 261 extension levels are where institutional traders often take profits. Let me show you this system in action. We have our uptrend. Price pulls back to VWAP, and that line happens to be right at the 61% Fibonacci retracement. That's your perfect entry zone. Now, instead of guessing where to take profits, you use the Fibonacci extension tool. You draw it from the start of the pullback swing to the end of it, and then back to the entry point. This gives you a clear plan for where you might take profits instead of just guessing. By combining structure, VWAP, and Fibonacci, you now have a 3-layered confirmation blueprint for your entries and exits. You now have all the pieces, but I'm going to show you how to put them together into a systematic approach that eliminates all the guesswork. I call this the A+ setup scorecard, your quality control system that separates opportunity from mediocrity. Here's how it works. Every potential trade gets scored on 5 criteria. Point 1 is the 1-hour chart trending. If price is clearly above or below the 50 EMA with clean market structure, you get 1 point. Point 2 is price testing a key support or resistance zone. If your pullback is happening at key level that has proven its importance, you get 1 point. Point 3 on the 5-minute chart is price testing the VWAP inside that zone. If yes, you get 1 point. No VWAP test, no entry. Point 4 is their Fibonacci confluence. If your VWAP test also lines up with the 61% retracement level, you get 1 point. Point 5. Do you have a clear outside candle signal? If the market is showing you strong rejection at your level with conviction, you get 1 point. This scorecard eliminates emotional trading. You're not trading because you're bored or because you feel like you should be in the market. You're trading because the setup meets your criteria like a checklist for success. A 5-point trade is perfection. A 4-point trade is excellent. A 3-point trade is average. Anything below 3 points is a pass. Most traders take 3-point trades and wonder why they are not making money. You're going to wait for 4 and 5-point trades. This is your filter for quality control. Let's lock this in. You now have all the components. The final step is to distill this entire strategy onto a single page. This is your playbook, your business plan. Take a screenshot of a perfect 5-point trade setup, print it out, and put it next to your monitor. This is your template for what to look for every single day. If you have 4 or 5 boxes checked, you take the trade. If you have 3 or fewer, you wait. This is your entire business plan for the next 100 days. Your only job is to hunt for this single picture. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.